Imagine you wake up tomorrow with $1 billion. What is your very first move? At this scale, the priority shifts from trying to get rich to ensuring you stay that way. Many assume billionaires simply buy the same popular tech stocks as everyone else, just with a lot more zeros. In reality, the strategy they use to protect 10 figures is the polar opposite of the one most people use to grow 4. The average investor asks, "How can I double my money this year?" A billionaire asks, "How do I ensure this capital continues to compound for the next half-century?" Multi-generational wealth stems from a financial architecture designed to survive decades of market cycles. It is a product of engineering, not luck. For the ultra-wealthy, a market crash isn't just a temporary dip. It represents the potential disappearance of hundreds of millions of dollars that could take 20 years of growth to replace. While a retail investor might hunt for a quick sale, the billionaire views a major downturn as a threat to their family's survival. The math of recovery is unforgiving. A 50% loss requires a 100% gain just to get back to zero. If you lose half your capital, your remaining money has to work twice as hard just to break even. Because this mathematical trap can paralyze a portfolio for a decade, billionaires design their holdings as defensive structures first. They value the ability to stay in the game over the chance to chase every temporary market boom. Billionaires accept risk, provided the failure doesn't result in the total destruction of their capital. They filter for situations where the potential downside is strictly defined. This is an asymmetric opportunity. The investment is structured so the potential for reward outweighs the maximum possible loss. You are looking for a coin flip where the odds are tilted heavily in your favor. These setups act as the primary filter. If an asset doesn't offer a lopsided ratio between what you could lose and what you could gain, it has no place in the portfolio. When it comes to public stocks, the wealthy follow a two-step process. They build wealth by concentrating their capital into a few businesses they understand deeply, then diversify that capital later to preserve those gains. Private equity offers something public stocks cannot: control. By owning a private business, a billionaire moves from being a passenger to being the driver, directly influencing growth, hiring, and pricing strategies. Real estate provides the mechanical foundation. Properties like warehouses and apartment complexes offer a hedge against inflation and a stream of income that continues even when the stock market is in freefall. They also maintain significant cash reserves. This isn't for the interest rates, it's for the optionality. When fear hits the market, cash becomes the leverage needed to acquire high-quality assets at a discount. These assets function like interlocking gears. If the stock market engine stalls, the real estate and private business engines continue to turn, keeping the entire system resilient during a recession. Most investors buy an asset and hope the price goes up so they can sell it. Billionaires focus on acquiring assets that generate continuous, reliable cash flow. Cash flow provides infinite holding power. When your assets generate a surplus of revenue, you are never forced to liquidate your positions to cover expenses. You can wait out a market crash without selling the underlying asset. This enables a sophisticated tax strategy. Instead of paying capital gains, the wealthy borrow against their holdings. Because loans aren't income, they access cash tax-free, while the original asset stays invested. This system allows the owner to fund their lifestyle using the exhaust of their investments. The principal capital remains untouched, compounding in the background and away from the reach of the taxman. The most critical component of this system relies on psychology rather than finance. It is the ability to maintain discipline through decades of market cycles. Many investors short-circuit their own progress by reacting emotionally to a downturn. They interrupt the mathematical process of compounding exactly when it is most effective. Compounding reveals its true power after years of uninterrupted holding. Like roots fracturing rock, significant growth happens quietly over very long periods. Discipline serves as the ultimate defense. It ensures the system you've built actually has the time it needs to work. You don't need $1 billion to apply these principles. The mechanics of capital protection and cash flow work at any scale, whether you're managing $1,000 or $1 million. The transition starts with a shift in identity. A speculator trades time for currency and tries to guess which way the market will move tomorrow. An owner focuses on acquiring productive systems. They seek assets that produce value 24 hours a day, regardless of whether the owner is working or sleeping. Wealth grows through systematic acquisition, not through lucky shortcuts. The sooner you start thinking like an owner, the sooner you can build a system that works for you. Start acquiring your first productive asset today.